Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
So welcome back to the Winner's Playbook. My name is Steve Sloan. I'm here with my colleague and co-director, Josh Lee. Josh, how are we travelling this week and what's the latest on your side of the fence, mate?
Yeah, short week, obviously. We got Easter, so we got the public holiday tomorrow, and then we also got the one on Monday, which is incredibly fun. Busy. I won't lie, I'll be working over the weekend. I'll be getting a few hours in there because if I don't, it will just absolutely snowball up on me. But no complaints on my end. Probably I've actually started pushing out some client meetings. I've hit near a bit of a capacity where I haven't done before, and I don't want any of my client experience and advice that I'm providing to be compromised in any way, shape or form. So there is, I suppose, a limit to how many people you can actually work with at once. And I've kind of put a bit of a cap on that for a couple of weeks to just allow me to focus on those that I'm working with at the moment. And then we'll open up the doors in a couple of weeks for some new ones to come through that need some advice. So good problems to have, but flat out as always. What about yourself, Steve?
Good to hear. Yeah, I was in Melbourne this week, seeing the team. It was fantastic. Back in Adelaide today. Mind you, I was at the airport yesterday and I managed to do a couple of TikTok videos because I haven't been on TikTok. Yeah. I managed to get a couple out, which was a bit of information there. And that you are very famous, if I want to say that, on TikTok, Josh. You got lots of. How many followers you got now?
I think we're about 54,000 odd somewhere.
54,000. Yeah, I'm not quite there, but that's very good. But one of your famous TikTok videos, which had 1.5 million views that went out at the end of last year, was all about tax structures and specifically trusts, which we're going to be talking about today. The ins and outs of family trusts, why do family trusts. That was a very popular video by the sound of it. So a lot of people like to hear about what is a family trust and why do you use it. But if we kick off, mate, and we start talking about our topic today, which is family trusts and the benefits of those, give us your rundown. What does it take for people to need a family trust to one, and why should you do it?
Yep. So obviously, there's a bit of a misconception that everyone thinks family trusts are just for the rich. Couldn't be further from the truth. However, of course, a lot of the wealthy do utilize these structures because you can get a lot of benefit from them. Now, in terms of, who are they going to be for? They're definitely not going to be for the mass majority of Australians. I always like to say that up front. I use a story of early in my 20s, I was reading a book and it was something along the lines of how to grow a property portfolio of 100 properties or something like that. And the guy was talking about trust structures, and that was probably my first ever exposure to trust. And I was like, God, that sounds like a good idea, a family trust. That sounds cool. Here I am 2021 and then I turn around to my now wife, Lana, and then told my mum, I'm like, I think I'm going to set up a trust, guys, and start doing some investing. But didn't know what was going on. It just sounded like a good idea. And that's, I think, a part of it is a lot of people, it sounds like a good idea having a family trust in this entity and all this, complexity and things like that. It's a cool sort of idea to say that, I've got all my assets in a trust. But the reality is a lot of people can't really benefit from them. And the main people I see benefiting from a family trust, one simple one is business owners can benefit a lot from a family trust, because the two main, I suppose, areas of why using a trust can be beneficial is one, if you need it for asset protection. It's obviously relevant for us in business, asset protection. As business owners, you typically don't want to have assets sitting in your own individual name. If something else were to ever happen with the business, that can all sort of come down, and you don't want to tie it up with all of your personal assets. And then the other major benefit, which is why people most commonly think of a family trust, because they want to save tax. And I think that's what probably took and got so many people interested in that video I did was, who in Australia doesn't want to minimize the amount of tax that they pay? I've never met someone to this day that doesn't want to do that. And if there's a way of doing it, we as Australians, we want to hear about it. And that's how a family trust can be a really cool structure to utilize, is for that tax minimization, which we'll get into how that essentially works. But what about if you can then, sort of describe, Steve, like what actually is a family trust? It's not a person. Like what actually is a family trust itself?
Yeah, look, I'd say this is it's an entity, right? It's a discretionary trust. Normally, so effectively that's it. Like the easiest way to describe it is just an entity, like a person is an entity. A family trust is an entity, but what it is, it's effectively a holding entity. So it can hold assets and allows you to have flexibility. So if you're holding assets within that entity, like instead of holding it in your own name, for instance, you're holding it within that entity, it gives you then the flexibility to control who ends up with the gains of that entity, generally an investment type of asset. So who's going to end up with the gains and who's going to end up with the income over the journey, effectively. That's the best way to describe it. And that's what it does. A family trust gives you that flexibility to decide year on year, sometimes throughout the year, multiple times, where that money or asset growth is going to land from a tax perspective, as you alluded to.
Yeah, so I think the biggest thing is trust gives you flexibility. But what about if we what sort of assets do we commonly have clients holding in family trust? What are the main asset classes that we generally see?
Yeah, so you know, anything to do with investment purposes can be in a family trust. Property is one. You can obviously hold property. Definitely business is the big one. If you're a business owner, most of the time you want to have that within the family trust, or a trust for that matter. But then you might have shares, managed funds. So look, it's pretty broad. The only thing I would say, and funnily enough, is what I spoke about yesterday with a family trust TikTok I did, was property sometimes in your own name can be quite beneficial from a tax perspective. So the balancing act is that tax question again, whether it should be in your own name or a family trust. But outside that conversation, the negative gearing conversation, definitely most asset classes that you're there to build wealth with, it'd be hard pressed not to be putting them in a family trust. If you've got if you're generating, good incomes, good wealth over a long period of time, that it'd be a hard case to prove that it shouldn't be in a family trust. It just depends on where your marginal tax rates land and the like.
Yeah, I think that the three big ones that I always with clients is business, property, and investment portfolios. So shares, managed funds, ETFs, typically what I see. For business owners, the family trust itself is just providing a layer of asset protection for any assets in there. But then if you do have your company that you're a part of, say Link Wealth Group, for us, which is where you want to then have that separation between, we're not building up essentially assets in Link Wealth Group. We build it up in our own respective family trust to keep it all separated from an asset protection point of view. But for business owners, the benefit there is, businesses, if they're making a profit, they're going to pay out those profits in the way of dividends. And then if the shares of the company are owned through the family trust, when then those dividends can be streamed or passed through the family trust, and you can ultimately distribute those possibly in a more tax efficient manner to other beneficiaries, of which can be very broad. It's very critical to understand, like, beneficiaries of a trust are those who are entitled to the income of the trust. And that could be, yourself, it could be your partner, it can be your kids. But it's critical to understand for kids, you can't really distribute much income to them other than $416 until they're over age 18. So you got to be really careful of that. You can it can be quite broad, and it's probably worth noting that one of the most important documents that gets established, and this is, let's maybe talk about establishing a family trust. How do you do it? You have a conversation with your advisor, your accountant, and they're going to get the lawyer to draft up what's called a trust deed. And a trust deed is basically a document that governs how that trust is going to be operating on behalf of the beneficiaries or that family group. So it's a pretty lengthy document, and it's going to outline all those key things of how that entity is going to be operating, and then notably also who can be the beneficiaries, which can, like I said, yourself, your partner, kids. Could also be a company you can set up as a beneficiary, which is its own conversation in itself. But it can be quite broad. It can be aunts, uncles, grandparents. But one thing I would say there is it's not as simple as going, okay, my grandma doesn't work and she's retired, so wouldn't I just distribute a lot of income through to her? There's other considerations you need to be wary of, like if you've got grandparents that are getting the age pension, if you're distributing income through to them, you could have impacts on that side of things. Or if you've got adult kids or nieces and nephews and so on, distributing income through to them and they're getting benefits from the government through study or whatever it may be, could also have some implications from that respect as well. So it's not super clear cut. You definitely need to be getting some good advice. But in essence, you get it set up. The lawyer does the trust deed, accountant will open the company associated with it, and then you're essentially off and running at that point in time. But what about the company associated? So what you commonly hear like a corporate entity set up, and what like the basics between the individual and corporate trustees, Steve. What are they? Because we typically I don't really ever see an individual company trustee at all. I don't think I've really seen one thus far.
Yeah, funnily enough, I had one this week,
There you go.
which is rare, right? So you got two options: individual trustees, which is you as the individual is the trustee of the trust. You control the trust individually, or you put in a company. So the company, you set up a new company. The company is the trustee of the family trust, and absolutely, you want a company set up, and you're the director of the company. It gives you that level of protection. So say something touch wood as a business owner, you get, if you got sued, if you're the individual trustee of a trust, it does open up the ability potentially to get access to those assets within the family trust. You want to separate yourself as much as humanly possible when it comes to asset ownership and yourself when you're a business owner. Sometimes even not a business owner, sometimes just in general, you want to separate yourself. So what you do is you put a company in as the trustee of the trust, and then you're the director of that company. Gives you that level of asset protection. It's purely an asset protection thing. It's not a taxation thing, but it does assist, and absolutely we want to go that way. And we do that whether it's a family trust or a self-managed super fund for that matter, which is another form of trust. They're all trusts. They're just holding entities, right? But yeah, that's the way we want to play. And if Josh, just on that, then if people are listening to this and they go, right, well, what's the cutoff point? When should I have a family trust? What's my asset value? What do I need to say, what, it's about right time to have a family trust? Where is that point?
Yeah, that's a really tough one because there is no clear-cut way to answer. I think naturally, if you're a business owner and you're going to grow and scale business, it's a bit of an easier conversation to say, yeah, a family trust can be beneficial. If you're an employee, does that mean you shouldn't use a trust? Well, no, it doesn't. If you've got good cash flow coming into the household, and I've got plenty of clients in this situation, both in a hubby and wife or a couple, and they're both in the highest tax bracket. Got plenty of free cash flow, so surplus income. They've got a lot of money that they can invest, and maybe they're in their late 20s, early 30s, whatever it may be, and they've got a long runway to build up wealth. Doing that through a family trust can be really beneficial because what are your options? If you're not going to use a family trust, you're going to invest probably in your own individual name, which is what everyone does. The problem that you have there is you don't have any ability to choose where the income flows year on year. And let's just say hubby and wife want to build up a multi-million-dollar investment portfolio. They open it up in joint names. Every year the income is going to be taxed 50-50. Any income from those shares or whatever it may be, taxed 50-50. And then when we get to a point of maybe starting to sell down on that portfolio, when we get to retirement or whatever it may be, we might want to start taking out some larger lump sums. Again, the taxation is just going to be based upon that ownership, 50-50. Whereas the family trust, where that can be really beneficial is, say, all right, same situation, hubby and wife, they're both in the highest tax bracket, but who knows what life looks like for the next 20 years? Like someone might stop working, someone might have a significant change in role, income drops significantly. Maybe someone, continues on into work for longer, someone partially retires sooner. The family trust is just going to allow you to every year look at the situation and then make a determination around where the income should flow in the most tax efficient manner. And that's the biggest thing, is the flexibility you get from it. Now, to try and answer the question a little bit better though, if you don't have a good surplus income and you're not going to be making a lot of investment, that's probably where a family trust is not going to be that beneficial. And like as an example, if you're just going to be investing, $500 a month into a share portfolio, would you open up a family trust for it? Probably not. If you're going to be buying properties, maybe there's a conversation to be had there, which we can touch on. But you want to have a good amount of income that you're going to be wanting to invest and then hold through that family trust and then get the benefit of the flexibility for the longer term. So I think it is really important if you're trying to build up a vast, a good chunk of wealth, multi-million-dollar assets, that's where it can make sense. And the longer runway you've got to do that, if you're in your 20s or 30s and you're earning really good income and you're going to invest for the next 20 years, well, it's probably likely that you can get a benefit out of using a trust. But there is honestly no simple clear-cut answer. Every situation is going to be different. I've had some clients come through recently where I originally thought it was a good idea for a trust, and then after kind of going through and decking out some numbers and doing some projections, we kind of collectively agreed that we probably don't need to go down the trust avenue. So all I would say there is, if you're ever in doubt, just have a conversation with your advisor or your accountant initially. Open up the conversation. But I think more importantly there, Steve, it's just going to come down to their goals, and what they're actually trying to achieve.
It's a real tricky one, because you set them up for the future, right? Like, it's a 10-year conversation at minimum. So if you're going to have a pathway to build a lot of wealth, even if you don't have wealth now, it may be beneficial to do it. So it's a tricky one, and it's all about those goals, right? Like, if you sit down with a client, go, right, your goals are big, and we've got a lot of moving pieces here. We've got a lot of plans to build a lot of wealth, and et cetera, et cetera. Well, then it's probably likely we might go that way. But if your goals aren't like that, or, it's as you said, it's a really different kettle of fish here for different people. And clearly that's where an advisor helps, right? Because they can set that out and work out if it's going to be beneficial or not in the next 10 years. But it's a 10-year play. Because I know when I set up my family trust, I didn't really have a lot of wealth, to be honest. But clearly that was crucial for me, because the business grew over time, and that wealth, if it wasn't in a family trust now, the tax consequences would be massive compared to what they are. So it was clearly the right decision for me. But at the time, I didn't have that much money. So it's about decking out your future, right?
Yeah, and it's more of it's exactly right. It's not a here and now benefit. Like sometimes you're setting these entities up, and you might actually be, from a cash flow perspective, because I guess we got to clearly say, well, what are the cons of actually setting up a family trust? Like, we're talking about all the benefits, which is asset protection, tax minimization, but I think the major drawback is just the cost. So setting up your family trust, of course, is going to vary between accountants, but generally 2 to 2.5, somewhere in there, as a setup with the corporate entity in it. And then on an ongoing basis, your taxation requirements are different, because you're not just going to get your individual tax returns done every year from your accountant. The accountant needs to do it for the trust as well, and the company associated. So you're probably looking anywhere between 2 or 3. I've seen many times where accountants are charging much more than $3,000 a year. I can talk from my own circumstances to manage that family group, and that's the one that you really got to weigh up. And that's why you got to really look at how much use you're actually going to get out of this. All right, maybe in the first couple of years, due to the costs and so on, you're going to be maybe slightly behind. But when you look 10, 15, 20 years down the track, and those assets have grown and compounded, and you're going to start realizing assets, that's where the benefit is. And that's where I always say it to my clients, it's we're not trying to seek a benefit for 1 or 2 years, because who's going to set up a trust for that reason? You're doing it because you're going to be building up wealth for the family over a 10, 15-year, 20-year period of time to get a benefit from that. And before we get closing out on it, Steve, I want to touch on property as well, because I get so many questions about clients asking me, buying property in a trust is a good idea. You touched on it earlier. You can't get a negative gearing benefit when property is owned in a trust. And what I mean by that, you can still have a negative gearing scenario, which is where your income from the property is lower than the expenses. So the rental income's 30K, your expenses are 40K. That's a negative gearing scenario. And most commonly, people own it in their own individual name, because they want to get that tax benefit every year, because that loss will then offset tax that you pay, and you're going to get a tax refund come tax time. It's a bit different with the trust, though, because that loss is actually trapped in the trust entity, and it can't be distributed through to an individual in your typical negative gearing scenario. But it can still offset other income through the trust. So if the trust has got, dividends coming through a business or an investment portfolio, the loss can offset that, but it can't actually go through to an individual and then reduce their personal tax payable. And it's also worth noting that land tax is higher, because the thresholds for when land tax kicks in are actually set lower through the family trust in the States. So it's not all, sunshine and rainbows. There are a lot of other things you got to consider. And in all honesty, I'm buying a property through a trust as we speak. But it makes sense for what I'm trying to do and where I want to be in life. But again, it really just comes down to, the individual situation. And is there anything else as a sort of a pitfall, Steve, you can think of with the trust?
Look, the two you mentioned are the big ones, but the other one is the government. Right. So the government loves to talk about family trusts a lot, pretty much every election we come across. Look, to date, there haven't been a lot of changes in that space, really significant changes, but it's got to be noted that they keep talking about it and threaten to make big changes to it. And whether it's retrospective, who knows if they ever make changes. But I think it's got to be noted that there is a risk there, like anything, right? There's a risk that they'll change the tax rates on personal as well. So I think you just got to consider that, but look, you can only really act on what you see at the time, really, because no one knows what each government's going to do, to be frank. But yeah, that's the only other caveat, apart from your costs that you mentioned, that negative gearing thing. Just adding to your point there on negative gearing, if you are going to buy property in there, then you want to make sure you've got a plan to get other assets in there, right? So if you get managed funds or shares or whatever it may be to get that income up to offset that negative gearing position, that's fine. But yeah, that's really the only cons I can think of. But I think for the right person and the right strategy, they absolutely have their place. And I think for me personally, it's probably saved me a lot of tax over time. But I think, obviously for the right person, the right setup, it can absolutely add a lot of benefit.
Yeah, no, one thing I'll finish on before we close it out then is, I had a question around, is it beneficial if you're single, getting a family trust and setting one up? And in the video I spoke about, well, you're going to be single forever. Like, do you want to have a family in future? Because you could still benefit from setting up and building wealth through your family trust, because then eventually you add your partner, your kids in there as your beneficiary. So again, it's not as just simple as you're single, it's off the cards, you shouldn't do it. Like, you got to really think forward into the future. And also worthy of noting, typically I get questions around for kids setting up trusts and investing for the kids. The benefit of the kids is when they're over age 18, you can start actually distributing income through to them through the family trust. But the point that you mentioned there is one of the possible drawbacks is the government changing the rules on you at any point in time. And that is something they have been cracking down on in the last year or two, is distributions through to adult beneficiaries, being the kids, because in the past, people and accountants were just on paper, say, distributing money to a 21-year-old child, and that kid was getting no benefit, not seeing any of that money whatsoever. So they weren't getting any of that. And of course, the ATO is now looking at that stuff a lot more closely. And I think, in finishing, it's probably worthy of highlighting, this is not stuff you go out and do on your own. And hence why you have your team of professionals, as we always say, around you. And in this situation, you might start the conversation with your advisor around the goals and whether or not you should be going the trust in the first place, because it aligns to your vision and what you're trying to achieve in life. But then also making sure you've got a good accountant on your team that can actually manage the taxation year to year and make sure you stay compliant and you do the right things. Because if you ever get audited, you haven't done things the right way, you could be paying back some extra tax. So before we close out, Steve, any other noteworthy items you think?
No, look, I think this is definitely an area you get the right advice. Deck out. This is definitely a future planning conversation, this one, because it's all about what's happening going forward. But get the right advice, get the right advisors on your team, and get the right structure in play, because it's not just family trust, it's company structures, self-managed super fund structures, or investing in your own name, and how that looks and feels is going to be different across the board.
Yep, great way to finish it. Well, guys, that's all we've got time for today. Everyone listening, appreciate that. And 5 stars on Spotify and Apple if you are getting value out of this. Check us out on all the socials. As I always say, TikTok, LinkedIn, Instagram, Facebook. You can kind of see us everywhere. You can't get us out of your feeds if you're on social media somewhere, which is maybe a good thing or not. And then, of course, if you do want to chat about your own personal situation, you can jump on the website, have a look at all the advisors. And if you're ever in doubt, guys, just feel free to come through for an initial chat. We don't charge for that, and we can at least help you understand whether or not you could be benefiting from any advice in the first place. So we'll finish up there. Steve, I'll see you on the next one.
Thanks, mate. See you then. Bye.
Catch ya.